Good afternoon, ladies and gentlemen, and welcome to the INSTEM PLC investor presentation relating to the results for the year ending 31st of December 2020. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Just simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it is appropriate to do so. These will be available via your Investor Meet Company dashboard and will notify you by email when they are ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit a couple of polls. The first one being, are you a shareholder of INSTEM, and then the second one relating to the recent acquisitions presentation. If I could ask you to respond to those, and they will be on the right hand corner of your screen in the polls tab if you have yet to respond to it. So do check that polls tab just to make sure if you could give a response to both of those polls so the management can see with whom they are engaging with this afternoon. So thank you for that. I'd now like to hand over to Phil Reason, CEO, and Nigel Goldsmith, CFO of INSTEM. Good afternoon to you both.
Hi there. Mark, thank you very much. So good afternoon, everybody. Great to be talking to you again. I'm just going to very quickly look at the polls. We've got so far 68% of you did attend the recent presentation that we gave on IMC on the acquisitions of the Edge and DWise. We have got some slides in this deck that talk to them, but we're not going to, as a consequence of that, spend too long on those slides. There is a recording available if you wanted to do a deeper dive on those acquisitions, but we will cover them. Without further ado, let us press on and give you an update. We're not going to talk through the disclaimer, you'll be pleased to hear. We'll very briefly introduce ourselves, even though most of you will have heard this just a week or two ago. I've been the Chief Executive of INSTEM since around 1995. I joined something called INSTEM in the early 80s. I got involved in this business in 95, moved from another division of what was then the INSTEM Group. And this business became independent of that wider INSTEM in 1998. I moved to the US in 2003, and then you may know that INSTEM did its IPO on AIM in October 2010 to allow us to access capital and to be able to use our publicly tradable equity as part of our M&A strategy. So that's a little bit about me. Nigel?
Hi, so Nigel Goldsmith, I'm the Group CFO. I'm based here in the UK. I'm a chartered accountant by training, spent most of my career in public practice with KPMG. I moved out into industry in the mid-90s. For those of you who may remember, I was involved in as finance director of a company called Mylor PLC, which became Sinclair Pharma eventually, although I left just before Sinclair. That was a named company. I've been in the industry generally now for, well, since the mid-90s. I joined INSTEM in 2011, so coming to my 10th year now, and looking forward very much to continuing the journey that we've been on. It's been fantastic, so thank you.
Thanks, Nigel. So a very quick overview of INSTEM. We'll get into the FY 2020 financials and some of the highlights. We'll look at each of the business areas that we had in the business during 2020, look at the strategy and outlook going forward, and wrap things up with a summary. As Mark said, please feel free to type questions in on the right hand side of your window, and we will come to those at the end. We'd like to make this as interactive as we can. So just a quick overview. So what is INSTEM? INSTEM is a a leading provider of IT solutions and technology-enabled outsourced services to the life sciences market. And it is great to come into work every day knowing that we are helping enable our clients to bring their life-enhancing products to market faster. That's never been truer than over the last 15 months when we've been actively involved helping our clients bring COVID-19 vaccines and therapies through the R&D process, and some of those onto the market. This summarizes the 4 business areas that we have, all market facing, and we do have some staff that are dedicated to each of these business units internally. Until the recent acquisitions that we'll come on to talk about, that we made at the beginning of March and the beginning of April, we had 3 business units, the 3 on the left: Study Management, Regulatory Solutions, and In Silico Solutions. The acquisition that we made on the 1st of April of a business called DWise that we'll come on to talk about adds a 4th business unit, Clinical Trial Acceleration Solutions. That's why that one is highlighted in blue. The one on the left, Study Management, is also highlighted in blue because that is where the 1st of March acquisition this year has been integrated into our study management solutions. Just in sort of simple terms, and there's a little bit more data on each of these areas later in the presentation, Study Management Solutions is a portfolio of software products that orchestrate studies that will run from discovery in research and development through preclinical development and into early human clinical trials. And we are collecting the data that goes on during the study, managing all of that data, helping people do the statistical analysis and reporting at the end of those studies, and for those studies that are relevant, formatting data ready to go into a regulatory submission. In Regulatory Solutions, we have 2 parts to the business. One that has developed over the last 10 years to meet a regulatory submission standard called SEND, the Standard for the Exchange of Non-Clinical Data. Here we are transforming data in the form it's collected into a data submission standard for the Food and Drug Administration in the US. We'll talk a little bit more about this business later on. The other half of Regulatory Solutions is in regulatory information management, and we are helping clients with the regulatory submissions they have to make as they launch their already approved products in each new country around the world. I'm going to do clinical trial accelerations next and come back to In Silico Solutions. So clinical trial accelerations came with the acquisition that we made, DWise, in April. And this is focused in 2 areas that we'll talk about later on, but it's helping with the analysis of clinical trial data, mainly for late-stage clinical trials. The reason I wanted to do those 3 first and then move to In Silico Solutions, a fundamental part of the INSTEM strategy is to be able to help our clients aggregate the data that they are collecting across this lengthy process from drug discovery through to late-stage clinical trials, and then to be able to explore that data and derive insights from it using in silico modeling solutions, so computer-based analysis of large volumes of historic data. Operating in those 3 other areas gives us access to and understanding of all of that data so that we can leverage that data in our In Silico Solutions business. The common thing that all of these areas have is that we're helping people collect, analyze, report, submit data to regulatory agencies, and then reveal new insights. Not necessarily from data that comes from our solutions, but also data that's in the public domain or other repositories of proprietary data. The leading market position that we've talked about has built up over several decades. We've offered our first solutions in this space in the early 70s. We'll see on the next slide that we've built up a portfolio of over 600 clients. Our philosophy in this industry is that we want to have the leading software solutions, the leading technology-enabled outsourced services, and we will develop those organically or bring them in acquisitively or through exclusive strategic partnerships, because the pharma industry in particular, but the life sciences R&D industry in general, has a history of wanting to license and access the leading technologies, the leading service providers, rather than to buy on price or buy in other ways. And unless you have the leading solution in the market, you will find it very difficult to compete at the top of any of these segments of the industry. Although we have over 600 clients, we've still got, and we are the market leader in the vast majority of solutions that we offer. There's still plenty of clients to go after, well over 4,000 target customers, and growing every year. One of the things that we have done over the last 10 years is to invest significantly in people and offices and facilities around the globe, everywhere that an appreciable amount of life sciences R&D is undertaken, so we can market to, sell to, deliver services, support our clients in their geography, in their language, in their time zone. That's been an expensive proposition, but those resources are now highly leverageable as we scale the business organically and acquisitively. One of the fantastic features about the business and the industry is that if you do have those leading products and services, you will enjoy very high levels of client retention. We routinely report that we retain over 98% of our client recurring revenue year on year. That doesn't include the upsell of new things to existing clients. This is purely if we generated £10 million worth of recurring revenue from clients for existing products last year, how close to £10 million do we achieve this year? And along with keeping hold of all our existing clients, that market leadership is not just in what we've won in the past, but is to also make sure that we have exceptional win rates for new business, and so that we continue to build on that market leading position. As I mentioned, we have over 600 customers. We have all of the top 25 pharmaceutical companies as clients, and many of the next 100. Pharmaceuticals accounts for about 90% of our revenue, so we will refer to pharmaceuticals on a regular basis throughout this presentation and others. But other important life sciences R&D clients are part of our portfolio, so in the chemical and agrochemical and pesticides area, the likes of DuPont and Dow, and similar businesses, as well as medical device businesses, and as you can see here, healthcare organizations like MD Anderson Cancer Center, who also do a lot of R&D and are involved in the development of new cancer therapies. For those of you who have been on an INSTEM presentation before, you will be familiar that we use this one set of data on one slide each year to talk about the market dynamics in which we operate. So the chart in the top right is the number of drugs in the regulatory stages of the global R&D pipeline. This is really important because the more drugs there are in the R&D pipeline, the more work that is going on, the busier the contract research organizations are, who today undertake quite a lot of this R&D on an outsourced basis for the pharma companies. And the greater the need is for our software solutions, the more users there are in the industry, and the more studies that are being run, the more demand there is for our technology-enabled outsourced services, where we are engaging in part of the R&D development process. The chart on the bottom right is where all of those drugs that are in the top chart are split across the various phases of R&D. So the great thing about the chart in the top right is the number has been growing healthily over recent years. The most recent data came out in March 2021 and shows another good step forward in the total volume. We used on this chart down in the bottom right to put a box around the preclinical phase and the early phase clinical trials, phase 1, because that's where our solutions were focused. As a consequence of the acquisition that we made in April of DWise, their target audience is actually in late stage clinical trials. So more appropriate is phase 2 and phase 3. So we've taken the box off this chart that highlights preclinical and phase 1, although still very important to us, because now all of these areas are equally applicable. For those people that might be doing the maths, the year-on-year growth in preclinical and phase 1 clinical was a lot stronger than it was in phase 2 and phase 3. That might be obvious and evident to people because it was widely published that a lot of pharma companies postponed, delayed their late-stage clinical trials over the last 12 months, while the healthcare industry was dealing with COVID-19 patients and didn't have the bandwidth to be able to do the discretionary participation in late-stage clinical trials. That has started to open back up again in Q4 of last year, and we expect will grow strongly again through this year. Despite that, there was still a modest growth year on year between 2020 and the 2021 data in late stage clinical trials. So, impact of, slightly weird, it's not showing up quite clearly for me. Why is that? So, on slide 11, we nearly left this out, the impact of COVID-19 on INSTEM, because really that was exceptionally modest. We had a slight slowdown or suspension even of orders from our academic clients. We generate typically £200,000 to £300,000 of new business from academic clients, and academia was closed until Q4 pretty much around the world. That bounced back again as academia opened back up. And we typically do about 60% of our professional services work associated with our software development remotely and 40% on client sites. During COVID-19, with all our staff working from home, we got that up to about 90%, but about 10% of our professional services work couldn't be done effectively remotely, so that remains in the backlog. And as we've opened up 2021 with that work still to be undertaken, and hopefully we will get to that. It's already starting to open up in some areas. China, for example, we've been back on client sites for several months now. We're starting to travel locally within countries, particularly in the US. Obviously, that hasn't been possible in the UK. Other than that, business was really not impacted by COVID-19. So with that, let me hand over to Nigel.
Thank you, Phil. So for those of you who've attended a presentation like this before on our results, usually start off with a slide like this that just gives an overview of the key performance indicators for us, which I'm pleased to say in all aspects we're ahead of the prior year on revenue, profitability and cash, which is obviously very satisfying. For the first time we exceeded the 20% EBITDA margin, which has been a sort of short-term ambition of ours. Our short to medium term goal is to drive that up to 25% and beyond. So we're on track to do that. I've got some further slides on revenues, which we'll come on to. This slide, I won't read every word on here because it's quite detailed, but a couple of key points to pull out of here on the left-hand side on the operational points. Recurring revenues, again, one of our big focal points is to drive recurring revenues and increase those. That consists of our annual support and maintenance, which is our traditional revenue stream that comes along with perpetual license sales, as well as the SaaS subscription revenues, which has been more recent, but is an area where we are driving the business, either converting our existing customers who have been on traditional license platform to move to the SaaS model, and also any new customers coming along as well. We realize that the multiples and valuation multiples on SaaS are significantly greater than other areas, so we're keen for our shareholder base to push along on that direction. We mentioned here about LeadScope. LeadScope was the acquisition that we made in November of 2019. It's only contributed 5 or 6 weeks worth of revenue and profitability in 2019. So essentially the first full year was in 2020. We're very pleased that they actually exceeded our expectations, driving revenues of about £1.9 million, a US-based organization, about 600,000 of EBITDA on that revenue, and as a good margin as well, slightly higher margins than the average INSTEM margin. So we are delighted with that acquisition. And strategically, we believe we've continued our on strategy. We've said all along, right from the IPO in 2010, that we would be delivering on an organic and strategic growth basis in terms of acquisitions, and that's what we've continued to do. Clearly, the two most recent acquisitions taking us to the next level, and we'll touch on those a little later. Again, very detailed slide. I'm not expecting you to read every word on here, but the headlines are revenues up 10% year on year. Cost-wise, our cost base is predominantly people, payroll representing 3/4 of our total costs in the year. Whilst we have an average number of employees, as quoted there, of 300, we closed the year closer to 350, and with the two acquisitions that we've made in 2021, we're closer to 450 global employees now. Nevertheless, despite those that investment in our people, our profitability was high. Our record year at 5.9 million of EBITDA, as I said before, 21% EBITDA margin, and that contributed to a very healthy cash generation, operating cash generation during the year, and again, meaning that we ended the year on a very positive note. Clearly, we had the £15 million fundraise that we made in July of 2020 for our acquisition purposes, but even without that, and take the 15 million out of the 26 million at the year end, we were very pleased with the year end cash position. In the RNS that we released this morning, we did actually give the current cash position of being circa 14 million after we'd made the initial payments on the acquisitions that we've made in 2021, just to demonstrate that we still have a very solid cash position, even despite those payments out. I mentioned that we would talk about revenues. I've got 2 slides on revenues. The first one is geographic. On the right-hand side, put so pictorially, quite easy to see that North America remains and is the dominant territory for us in terms of revenue generation, with a nice spread across the rest of the world in those 3 territories, rest of the world, UK, and rest of Europe, to mitigate any risk of being dominant in one particular territory. The acquisition of LeadScope, which is a US business, clearly added to the growth in the US side of things. We were fairly flat in the UK. Europe was a little bit, grew a little bit. UK has, over the years, has been up, has been down, and I would expect this year with the acquisition of the Edge to be pushed up a little bit more. Rest of the world remains very good. We had a Korean contract that we announced in mid-year of last year for $1 million across all our product suite, and that contributes to that growth in the rest of the world. But nevertheless, the North American market remains our largest market. And in terms of revenue by type, on this slide, sorry for all the different color blues, hopefully you can see that, but the majority of our revenues are recurring revenues, are SaaS and annual support fees, as I mentioned, representing about 60% of total. Historically, INSTEM has been a perpetual license selling business, but over time that has diminished as a proportion of our total revenues in favor of our recurring revenues, and also our outsourced service income, which has grown significantly over the last few years. And we just pull those two revenue streams, SaaS and outsourced services, out on the right-hand side, so you can see the trajectory of that growth over the last 5-6 years. And finally, a detailed slide on the balance sheet and cash flow. I wasn't intending to go through this in any detail. If anyone's got any specific questions, I'd be happy for you just to put those in the Q&A section, and I'll address those at the end. And I'll leave us at that for the time being. So thank you. Phil.
Thank you very much, Nigel. So let's quickly look a little bit more at the 3 business areas that contributed to 2020. So study management, in silico solutions, and regulatory solutions. Study management, we have guided people to expect mid-single-digit revenue growth year on year in study management. You can see that revenue was ostensibly flat between 2019 and 2020. 3 components to that depressed revenue growth in study management, 2 of which I've talked about. So those academic license sales, the delay in about 10% of our professional services. We do about £2 million worth of professional services, or have done over the last few years. So 10% of that was about 200k. The academic licenses were 200 to 300k. Plus, this also reflects the great success that we had securing software as a service business for new clients. We'd anticipated that SaaS revenue would increase by about 15%. During 2020, it actually increased by about 25%, which was fantastic. But one of the consequences of that is the short-term revenue benefit of perpetual licenses goes away to be replaced by the long-term recurring revenue stream from SaaS. So those 3 things combined are what depressed study management, but overall we're very comfortable with a sort of a long-term trajectory of mid-single digits revenue growth. Obviously that, as we look forward, might well be enhanced by the acquisition of The Edge in discovery study management. So we'll update that expectation as time progresses. In silico solutions, you can see that this has been growing strongly year on year. As Nigel mentioned, in 2019 we had about 6 weeks contribution from LeadScope, and in 2020 we had a full year contribution from LeadScope. And if you quickly do the maths based on the numbers that Nigel shared, you can see that organically in silico solutions growth was modest from 2019 to 2020. And I'll cover that now here. That's really all to do with one top 10 pharma client that we secured in 2019 for our target safety assessment technology-enabled outsourced service. We did about £400,000 worth of business for that client in 2019. We delivered quite a lot of target safety assessment analyses to them. And although it was flattering, it was somewhat frustrating that they've decided that they will implement a technology platform to support this type of work internally, and will only outsource a modest number of target safety assessments to us. And so We had less than 10 target safety assessments, probably generated less than £100,000 worth of revenue from them. So we've had to replace that revenue from that client with new clients, which we've successfully done, but it's meant that the growth in that area moderated. As we sit today, a great pipeline and some nice new client names have been added into our target safety assessment business. And then the third area, regulatory solutions, you can see that that's been growing nicely year on year, and is a combination of both technology and technology-enabled outsourced services. Study management, we've talked a little bit about as we've gone along. We're helping to manage the orchestration of studies from discovery now with the acquisition of the Edge through early phase clinical. This is the area where most of our SaaS revenue is generated, where many of our 600 clients, 600 plus clients are, where we have a huge appetite from clients to take more solutions from us. So although it is an area that is the lowest organic revenue growth area, it provides loads of fantastic client relationships that we can introduce solutions from the other higher growth areas, as well as generating much of our recurring revenue. Where we've been particularly strong in study management over recent years is the Asia Pacific. It's been strong again, and Nigel mentioned that large client, Biotoxtech, who placed their order in the first half of 2020. Regulatory solutions, I mentioned that there was two areas, technology and outsourced services, helping clients create SEND data sets, SEND being the standard for the exchange of non-clinical data. This is a mandated submission format to the Food and Drug Administration. The standard is something that INSTEM's been actively involved in the industry consortium defining this standard over the last 10 years. The standard continues to grow and evolve year on year as some of the more complicated study types that haven't yet had an approved standard. That work is completed. INSTEM continues to run several of the sub-teams of the SEND Standards Consortium and is widely recognized as the thought leader in this space in the industry. As well as helping people put SEND data sets together for regulatory submission, as the industry is beginning to cope with the work demand that is created to keep up to date with the timeline of submission of SEND data sets to the FDA, the industry has been able to start to turn its attention to creating SEND data sets, not for studies that are being submitted, but actually for the studies that fail during the testing process, but generate lots of valuable data about the safety and efficacy of drugs as they've gone through the R&D process, which can be used to inform other drug development programs as you start the discovery phase and you move through R&D. And so clients are starting to want to convert those study data that aren't being submitted for insight and exploration purposes. And that is generating both technology sales and technology-enabled outsourced services sales. Our regulatory information management business has continued to perform at a fairly steady level. We enjoy great client retention, and our clients continue to submit more and more applications to launch their products around the world. Our in silico solutions, I've talked a little bit about target safety assessment when we looked at the revenue. This is an area where we are bringing a new technology-enabled approach to a process that's been largely manually undertaken. We are sort of reinventing an approach which brings much greater integrity and coverage on the potential safety liabilities of modulating a biological target, something that you can do early in the discovery process, rather than trip over safety liabilities later through R&D when you might have already spent huge amounts of money in your R&D program. So target safety assessment is all around failing early and also identifying the safety liabilities that are probably tolerable based on your indication of your pharmaceutical and how you need to manage those safety liabilities and the studies that you need to run as you advance your R&D program. The other half is what came with the LeadScope acquisition that we did in late 2019. That business is was an entirely software business. We actually, in Q4 of 2020, launched a technology-enabled outsourced services offer in this space. So if people don't want to license the technology, but they want to take advantage of these technologies, they can now ask us to undertake this work using our technology on their behalf on an outsourced services basis. And all of the solutions here fall into a class of predictive analytics, where we're looking at large volumes of historic data and the connection between potential safety liabilities and the molecule structure or the molecule substructure, and being able to say with statistical probability the likelihood that you will bump into a particular type of safety liability with this molecule. Now, that might be an acceptable liability based on the indication. So if this is something that makes your hair fall out, but it helps address your cancer, that's probably an acceptable liability. If it made your hair fall out but helped you lose weight, that is probably not an acceptable safety liability. So it's both what is the safety liability and how does that safety liability relate to the therapeutic benefit. This is an area with this LeadScope acquisition where there is a huge appetite from both the industry and the regulatory authorities to do more with this in silico modeling. So you need to do less animal and human-based experimentation. Clearly, if you can identify these safety liabilities through in silico modeling, that is far more attractive than exposing certainly human subjects to those sorts of implications during a clinical trial. Again, an area that we are a market leader and a thought leader in the industry. So that talks to the things that contributed in FY 2020, brings us on to look at our growth strategy. You can see here at the top bullet of this slide that over the last couple of years, we've been sharing the view that management was aspiring to grow the business from revenue that was in 2019, just under £26 million, to revenue of between £50 and £75 million over the following 3 to 5 years. So doubling to tripling revenue from the level of 2019. As we're going to come on and talk about with the acquisitions that we've done in March and April of this year, we have significantly changed the scale of the business. Pro forma 2020 revenue for INSTEM plus the two acquisitions in 2020 would have been £48 million worth of revenue and £10 million of EBITDA. So we are already pretty much at the low end of that 50 to 75 million range that we'd set as a target a couple of years ago. So we have upped the management target here to a revenue of between 100 to 150 million over the next 3 to 5 years. As I talked about earlier on, we've put in place a global set of resources that we can leverage as we grow this business organically and acquisitively. And the more we leverage that will help us address the second of the three growth strategies that we see in the boxes below, which is the margin improvement that Nigel talked about. The more we can leverage that expensive global platform, the more chance we have of driving our EBITDA margins to 25% and beyond. And the third part of the strategy is around accretive M&A, which also includes, although we have it under the title M&A, it could be exclusive strategic partnerships. So we mentioned earlier on that we did an equity fundraise. This is the third fundraise that we've done since we IPO'd. The previous fundraisers have been much smaller and have been helpful in allowing us to do some smaller bolt-on transactions. The fundraise we did in July of last year gave us the capacity to consider taking on a more transformational size acquisition. And that is indeed what we've now consummated in April of this year. But as well as fundraisers, we obviously have the benefit of being able to deploy our operational cash towards our M&A activities, the issue of our publicly traded INSTEM shares, which is commonly part of the transaction consideration. And up until now, we haven't actually taken on debt for acquisition purposes. And so that capacity remains if that became appropriate. The driver for M&A activities, first and foremost, comes from the needs of our clients. The life sciences R&D industry, and particularly pharma R&D, has exhibited exceptionally poor governance over the last 30 or 40 years, allowing its departments and its scientists to buy technology solutions from two men and a dog through to bigger businesses, and it's ended up with a very fragmented landscape. And now that they want to integrate those systems to improve their operational workflow, and most importantly, to aggregate data for insight generation, that is a very difficult challenge when you have hundreds of IT suppliers supporting your life sciences R&D. So our clients are continually encouraging us to extend our technology platform to cover more of what they do, and to then make complementary acquisitions that bring more technologies under the INSTEM umbrella so that we can help our clients aggregate these solutions for workflow and data aggregation purposes. From a criteria perspective, there are more, but these are a couple of the top ones. We are looking for businesses that are already well developed, generating revenue, generating profit, that we can typically buy on the basis of a multiple of EBITDA. As a consequence, we would expect all of the acquisitions we make to be accretive to earnings, at least in the first full year post-acquisition. The two we've just made in March and April will be accretive to earnings in the part year of 2021. And because of those characteristics, we can set a target that says all of our acquisitions should deliver a minimum return on capital employed of at least 10%, and very rapidly get to 15% plus, which was consistent with the rest of the INSTEM group. So our three solution areas as they were prior to the latest acquisition: regulatory solutions, study management, and in silico solutions. They all have segments of those areas where we've been actively pursuing acquisitions. And the two that we've done this year, all of these areas were color-coded green when we presented this as part of the fundraise roadshow last June. And the two that we've just done, one in clinical data management biostats and the other one in discovery study management, are colored blue as we've now completed them. All of these areas continue to remain interesting to us from an acquisition perspective. So the two acquisitions we've done in March, a business called The Edge in discovery study management. It's a business that will cost, ultimately with deferred consideration, £8.5 million. We expect that we will pay for the earnout that is part of this business in full, and DWise that is again got some earnout, and we would expect to pay in full for this transaction that with deferred consideration will cost $31 million. So I'm not going to talk to the detail on the next few slides. This is where I said the acquisitions were very well profiled in an IMC presentation that we ran a couple of weeks ago. So please listen to those recordings if you'd like to know more in detail. The Edge is an entirely software business in discovery study management, really attractive, very complementary to INSTEM's regulatory study management solutions, and an area that our clients have been encouraging us to introduce a new solution either organically or acquisitively. And DWise, a business that focuses in late-stage clinical trials, has two fundamental offerings. One that helps people with the statistical computing environments, so the data management staff, the biostatisticians that are going to manage the data that comes from the late-stage clinical trials they run, and to do the statistical analysis at the end of the studies to see if those drugs are safe and effective. DWise has been a market leader in this area for a decade or more, has two types of offer, one for top 25 pharma, where it's provided large custom statistical computing environments in projects that typically take a couple of years and cost anything from $5 to $10 million, and then a more packaged, standardized statistical computing environment that is licensed on a subscription basis for small to mid-sized companies. The other part of what they do is an area called clinical trial transparency, and this is building momentum as a consequence of regulated requirement for any drug that is approved in the EMA or by Health Canada, that as a quid pro quo for approving your drug, you are obliged to provide anonymized study data for wider industry research. You have to anonymize the data because the subjects on those clinical trials granted permission for the data to be used just for the trial itself, not to be leveraged more broadly. So before that data can be used more broadly, you have to make sure that it's impossible to mine through the data and to identify the subject that was involved in the clinical trial. In this area, DWise provides both software that does the anonymization process, and increasingly is offering an outsourced service where the client will send all of its clinical trial results data to DWise. They will put it through its software and send the information back ready for submission to the EMA or to Health Canada. And if you want to learn more about either DWise or the Edge, please listen to that recording. This is a slide we shared when we did the fundraise. It showed 5 well-advanced targets, 2 transformational size targets, one of which we can now disclose was DWise. Target 2 was in an active sale process. We backed out of that process because we were in the exclusivity with DWise. That business has since sold. And 3 other targets, all of which remain potential acquisitions. And we still remain hopeful that one more of those, target 3 through target 5, might complete later this year. Just to give you some visibility into our ability to fund those transactions, if we take the cash that we opened the year with, £26.7 million, we ignore organic cash generation, but you'll be able to take the data from the progressive research note that has been published today, which has our their view on our organic cash generation, which we'll add into this table, And you can see that although ultimately we will need all of that 26.7 million if we generated no more cash or raised no more cash to pay the deferred consideration on LeadScope, The Edge and DWise, it does show that we have plenty of cash available to spend on another acquisition this year. And as Nigel mentioned, we have continued to generate cash. So as we sit today, that 11.6 million after we've spent the initial consideration on The Edge and DWise, we're sitting with 14 million pounds. So there's been good organic cash generation during the first 3 months of the year. And that brings us to a summary. It's great to see some questions building, which is fantastic, which we'll turn to. So we're really positive about the industry, positive structural drivers, so the number of drugs in the R&D pipeline, the large sums of money that are available to fund the biotech industry from both private equity and big pharma, the success that the industry is having, bringing new drugs to market, which was very successful in 2020, and obviously that's what generates some of the wealth to continue to invest in R&D going forward. We have a highly resilient business model with plenty of recurring revenue and good visibility on backlog services as we enter each new year. We've got a large client base that wants to buy more from us. We have a transition from on-premise to software as a service delivery, which increases visibility and quality of earnings. And we are very well placed to continue our organic growth, supplemented by highly complementary and accretive acquisitions. And with that, let's turn to the questions. So Julian H. has asked, could you talk a bit more about your competitors? What do life sciences companies do, or who else do they go to if they don't use INSTEM? So they vary by each of those 4 business areas that we now have. Generally, INSTEM is the market leader with each of our solutions, but we have some very credible competitors in each of those areas. Take study management, and our biggest product in study management, Provantis. Our 2 biggest competitors there are a company called Zybian. They are a private business headquartered in the East Coast of North America. They actually compete with us both in study management and the SEND area of regulatory solutions, mainly in the software space, although they have just started to make a move into outsourced services. And then the other business I would highlight as another long-standing, very credible and successful business in this area is a Swiss German headquartered business, but with big presence in North America. And again, they compete with us in both study management and the SEND space, both in technology and the technology-enabled outsourced services. They are great benchmarks against which we are continually judged when we bid for business. We continue to have strong market share advantage over both of those businesses, both in established business and business we win, but they're 2 respective competitors. We have similar competitors in other areas. It's worthwhile at this point, I guess, talking a little bit about the late stage clinical study management space, an area that we won't enter. And I suppose it's a good indication of us being aware of where we can be successful and sticking true to our belief that you need to be a market leader. So in late stage clinical trials study management, there are 3 multi-billion-dollar organizations. Oracle, a company called Medidata, who was in the last year or 2 acquired by a company called Dassault, and more recently an entry into that late stage clinical study management space, Viva, as well as lots of small competitors for those 3 big players. So that's an industry, late stage clinical study management, that we don't believe we will ever enter because we don't believe we'll be able to establish that market leading position. And so you see INSTEM entering a space acquisitively or organically, you can be fairly assured that we believe that we are already or will soon be the global market leader. So Nick J, great progress in difficult circumstances. What do you see as the greatest opportunity as you move forward? Nigel, would you like to pick up on that one?
Sure. Okay, so well, I think we're firing on all cylinders really at the moment. The biggest growth areas have been our move to SaaS and our growth in our outsourced services, our tech-enabled outsourced services. So I see those two areas probably the in silico solutions generally. I think clinical trial, the move into that opens up an enormous market opportunity for us. The total addressable market was on one of the slides, which is a huge step up for us. So I think really in each of those areas that we are sort of currently sort of placed, I think now we can start to really leverage the global infrastructure that we've put in place over the last few years, which has been expensive, and we've borne the cost of that over a few years, but I think we'll start to reap the benefits now as we grow forward. And as we get bigger, we're going to see more opportunities, I think, from an M&A point of view. I think we'll see companies coming to us as opposed to us seeking them ourselves as well. So I think we'll start to accelerate that progress as well. So I think it's a combination of organic and acquisitive growth, I think. Phil, anything to add?
Right. Yep, no, that's great. Thanks, Nigel. So Simon C has asked, how long does it take to fully integrate an acquisition and see the full benefits of cross-selling, etc.? So it varies a little bit depending on what we are acquiring. So something like the LeadScope acquisition that we did in November 2019, we set a 90-day acquisition integration program. We completed that pretty much to plan. One of the things that they saw particularly attractive is that they had been successful because of their reputation and engagement with the industry, but pretty much all of their staff were based in North America. They didn't have a sales force, they didn't have a global reach, they didn't have a marketing department, and we have been able to instantly educate our global sales and marketing team and start doing that work on their behalf. That, you know, they continue to have a fantastic market reputation, and it makes it very easy for our sales force and our marketing team to take this proposition globally. But we can start to deliver incremental revenue and started to introduce new clients into the pipeline, and we closed new business for them within the first 2 or 3 months post-acquisition. We expect to see something similar for the Edge, where again, the Edge doesn't have a dedicated sales and marketing function. All of the staff bar 2 are in the UK, and we can provide sales and marketing and that global reach. The Edge have found that because it's a relatively small business, they have in the past been excluded from tender lists for some of the biggest projects purely because of their size. And one of the things that they saw attractive of joining INSTEM is instantly they become one of the bigger players in the space rather than one of the smallest players in the space. Because once they get onto tender lists, they tend to win the majority of things they tender for, even if they tender against much bigger competitors. So we expect to be able to have a really positive influence. With something like DWise, where they've got a very established sales force internationally, they have a presence in North America and Europe. In our ability to be able to make incremental benefits for that business will probably take a little bit longer, but we would certainly expect to see those coming through in the second half of this year and into 2022. I'm conscious that brings us right up to the top of the hour and the end of the session. There are a couple of additional questions that we didn't get to, and there's a couple that were submitted beforehand, although I think they overlap with things that we have asked from the live audience. So I'd like to thank you. We will put written answers to those we haven't answered on the IMC platform. And we look forward to engaging with you all again, if not before, when we release our interim results in late September or early October. So thank you very much to you all, and have a fantastic day.
Phil and Nigel, thank you very much indeed for the presentation. I believe that you've addressed all the questions that you can from the investors posed today. And of course, ladies and gentlemen, the company will review, as has been said, all of the questions submitted by investors today and publish those on the Investor Meet Company platform. Phil, I don't know if you have any more closing words or summaries to add before we redirect the investors to provide their feedback for today.
No, I don't think I do, Lloyd. Thank you.
Thank you very much indeed. I think it was very comprehensive, what you've covered already. Anyway, could I please ask investors not to close this session, as you will now be automatically redirected for the opportunity to provide your feedback. If you did access this meeting from our website, the feedback page will appear. But if you access this meeting via the link sent to you by email, you'll simply be asked to log back in to submit your feedback. On behalf of the management team of INSTEM PLC, we'd like to thank you for attending today's presentation. Now that concludes today's session. Thank you very much indeed.
Thank you.
Thanks, Lloyd. Bye-bye, everyone.